Kunj, hi, good afternoon. Thank you so much for making time for ET Now. First up, and that is the question we are asking all our experts, how do you wade through this volatility, the amount of headlines that we are tracking in a matter of day and the kind of range we have seen as far as the market is concerned? Do you just shut shop and completely ignore the noise as one of the experts was telling us? Or maybe it's time to nibbling into the sectors that you have been liking?
Yeah, so if you ignore the noise, what do? You just sit at home. If you are having an existing portfolio, it keeps getting flooded. And if you have cash, you don't invest. So I don't think that is the solution. The solution, or before the solution, one, we need to understand that an continuously increasing and increased globalized, fully linked world and the economies, along with the fact that the almost instantaneous, not on a daily, not on an hourly, not on a minute basis, almost instantaneous social linkages, online availability of information, along with that online availability of views, perceptions, fake news and rumors, obviously distinguishing it from the real news. One has to build in all these factors that the volatility will be too high for the same amount of change if that change were to have happened, let's say 2 or 3 years ago or 5 years ago. So that has to be, one has to build in, and accordingly the strategy has to be built in. Now, coming to the strategy, I think one has to clearly define, as I said, shutting shop is not a solution. But one has to clearly define that where one stands in terms of the market participation. We, of course, at the if we talk in terms of timing, at the extreme short end, we have the traders, intraday or at best intra-week traders. It is presumed that they know what they are doing in the market, they understand trading, they understand stop losses. If they are doing it on the basis of technicals, they understand that, and accordingly they have to trade with strict stop losses. Of course, these kinds of market are very difficult. In within today itself, we have seen market opening at a certain level, and then there was an NSE glitch in which one didn't know where the market is going. Then market went down and we have seen the recovery. So even intraday trading is difficult, but that, as I said, they have to trade accordingly. Leaving that aside, if we come to the other segment of the market participant, there can be two, three different sub segments. So there can be some people who, for the last 1 year, 1.5 year, were not investing because market was continuously going up, or investing but not as much as they would have wanted, and they were waiting for correction. They had some surplus money or have it now. They shouldn't wait for any more correction. Correction can come. In fact, my view is that correction is likely to stay for some more time, if not in the index, certainly in the individual stocks and sectors. But coming back, if they had a relatively lesser asset allocation to equity compared to what they wanted, and they have surplus cash, they should certainly start investing part of that money. One will not be able to catch bottom. Moving on, another segment in which, if some people are short of are highly risk averse or risk conscious and cannot see the volatility, cannot see the downside, they shouldn't start investing now also. Of course, they should be then ready to invest at a higher level, because as I said, it will be very coincidental if one is able to catch the bottom for 100% of the investment that one wants to do. For 10%, 20%, maybe you will be lucky enough to catch the bottom. But if you are highly risk averse and you don't want to see the volatility, you don't want to see the prices going up, they shouldn't invest. They should wait for market to bottom out. Where it will be, when it will be, it will again remain difficult, but then they should be ready that they are happy to invest at a higher level and then invest. So till then they have to wait and watch. So in my view, that's how one will have to wade through this market structure.
What do you make of the moves that we are seeing as far as the banking space is concerned? I mean, just a couple of months ago, people were willing to bet on the names like Bajaj Finance, etc., when they were trading at 7 times the book value. HDFC Bank was something that people were, wanting to buy at that level. Now, nobody is willing to touch all these counters. What has changed so dramatically in a matter of a couple of months, especially for these so-called domestic-facing sectors?
Yeah. So clearly, what has changed is the whole market look and feel, market construct. The sentiments have changed. You are right that the results for some segments, some sectors at least, may not uh, have changed as much in the recently went by September and December quarter and in the coming March quarter, although the impact is likely to be there all across, in some cases directly, like the commodity based sectors, in some cases indirectly. If we talk of banks, it's likely that some of their clients might go bankrupt. I mean, bankrupt is an extreme word I am using, but might have some stress and might want to delay payment or might want to come up for restructuring and things like that. There'll be some people who have borrowed money, individual loans, personal loans, and their jobs are at stake, or if they were SME kind of business, they are again not able to repay. So those kind of indirect impact will come on banking also. But coming back, even in the sectors, you are right that domestic facing or much less affected by these kind of developments. What has clearly changed is the market sentiment and the liquidity flow. Now we know that since October we have continuously seen FII outflows on a net basis. Banking was one sector which saw maximum inflow, or rather the maximum part of the FII inflow going to, if any one sector was there, was the BFSI sector. And that's where, when we have seen the outflows also, it's obvious that this is the sector from there where the outflows have gone, are going, and will continue to go if the FII outflows still continue, which they are likely to continue in my view. So that is, I think, one thing which has changed. In a rising market, this was the liquid sector. This was reasonably high quality in terms of fundamentals, in terms of corporate governance also. So valuations were being kept aside for a moment, because one also wanted to be safe, one wanted to be liquid. So I think that's what has changed, that now in an outgoing market also the liquidity will be drawn from such sectors first.
Kunj, good afternoon. Just prior to all of these tensions that we had seen, there was a lot of promise that was, being seen in the real estate space, in terms of even the corporates that we spoke with, talking about how there had been strong, foreign capital flows into the real estate sector, that the road ahead was looking fairly promising, that we were seeing strong demand. A lot of uncertainties that were predominantly due to the pandemic were now behind. But now we're seeing the real estate sector, in tandem, of course, with the rest of the market, is being quite badly bruised out of shape, at least when it comes to individual stock prices. What do you advise one does within this high beta pocket?
Yeah, so if we continuing our discussion on the market, if we keep a view that let's accept that market might remain volatile for some more time to come, and volatile is a soft word to use, maybe who knows, may correct for some more time, then over a period of time, obviously there'll be sectors which will be outperformers and sectors which will be underperformers. It's obvious that when I say outperformers in a falling market, they'll fall less, but they will also fall. Which is where I think the real estate comes in. In fact, before I come to real estate, let me also bring in that in my view, IT sector is something which clearly will continue to be an outperformer even in a falling market, given the way the growth rates are likely to be there. Of course, margin pressures because of the rising salary costs are already built in. The currency depreciation over a period of time tends to get passed on to the customers, but in a shorter term, companies might benefit for part of the currency depreciation. So that will be positive. So coming to real estate, that will be another sector which probably can remain an outperformer, although will fall, and we have already seen the fall happening with the market. The problem there in terms of fundamentals will happen is that the costs will certainly go up. We have seen the gas prices going up, gas stocks taking a sharp beating. Now, gas cost is quite a reasonably significant part of costing when it comes to building materials like sanitary ware, like tiles, like ceramics. So we can see a pressure there. We are already seeing commodity costs going up. We are already seeing costs for cement companies going up very highly in terms of coal and coke prices. We will probably have today evening fuel hike coming in India, petrol and diesel. So that will increase the transportation cost for cement companies for all the sectors. So that's where the cost of construction or the redevelopment or the development, the cost of ancillaries, accessories required for real estate development will go up. Now, that is an indirect impact that market will somewhere start to build in while giving valuation or while giving stock performance to real estate sector as well. So within the overall construct, it will remain an outperformer, but yes, we can see the pressure there as well in terms of financials and as a result in terms of stock prices.
Chatting with Mayank Parekh from Parley Products earlier today, and they were talking about the kind of agri-inflation as well that's really sort of, dampened things for them. Be it wheat, which has perked up a good 30%, again, a fallout of what's happening across Ukraine and Russia, barley, for instance, and add to that fuel in any case, along with edible oils, has been a looming concern as it is. And they were talking about as to how once the reserves run out, they will have no option but to pass it on to consumers in terms of a price hike. And that's surely going to, in heightened inflationary environment like right now, make the consumer a little conscious as well and may dampen their volumes as well going forward. Wanted to understand if as an investor, you're going to steer clear from the agri commodity sensitives and in particular the FMCG companies.
Yeah, so let's add the recently hiked milk prices all across India to the list that you mentioned of increase in prices in oil, palm oil specifically, edible oils, the wheat, and all other related agri products. Yes, indeed, it's a challenge, and the indirect inflation. So as we were discussing a while ago, we will most likely today, after the end of the last phase of elections in the UP, as early as today evening, if not within next 1 to 3 days, we can have a significant fuel hike. Hopefully, government should reduce excise duty, but even then, on a net basis, there'll be a reasonably decent hike in fuel prices, which will add indirectly to the inflation. So that is indeed a challenge, and that will have an impact. So while we know that the whole industry, specifically FMCG, has been passing on the price hikes, but then there is a demand elasticity or inelasticity, whichever way we put it, to the price hike, and the companies very well understand this. This is already reflecting in the reduced or rather slowed down demand that the FMCG industry is having. In fact, as an extension, it's also reflecting in the stock prices, wherein most of the FMCG stocks over the period of last 5, 6 trading sessions or so have touched their 52-week low or are trading close to that. In terms of investment approach, yes. So coming back to linking it with the market view going forward in the near future, let's say next few months, and the expected outperforming or underperforming sectors. As I was mentioning earlier, in my view, the outperforming sectors will be one very clearly the IT sector, which will continue to see the increased growth rates with some pressure on the margins, if at all, that will be there. The other outperforming sectors within the low beta will come from the pharma. So pharma sector has already been underperforming for quite a while because of the reduced growth rates and the pricing pressure in the US, as well as the lower growth rates in the domestic market. But there the demand elasticity or the price linkage stops beyond a certain price levels or the cost levels. So that won't get affected as much the now coming to FMCG will get affected because of the increase in the raw material prices. As a result, if companies don't want to take a compromise on their margins, they will continue to hike prices and will see a demand impact. So while I am nobody to advise the FMCG companies, I think time has come wherein they should clearly be ready to take reasonably significant impact on their EBITDA margins. Let's say at least around 300 basis point odd. That will help them continue to have growth. That will motivate the consumer to keep buying product and will support growth for the economy as well. But pending that, in terms of investment approach, yes, for now, despite the 52-week low availability of the sector, the prices, the companies, I would not be jumping in right now to invest in the sector.